It's time for the Property Podcast, where every week tens of thousands of property investors, new and experienced, join together to get news, knowledge and laughs at our expense. With me, Rob Bence.
And me, Rob Dix. Join us every Thursday morning for your weekly dose of property ideas and motivation. Then head over to our website at thepropertypodcast.com to keep the conversation going. Now though, let's get started.
Hello and welcome to the Property Podcast. It's episode 47. I'm Rob Bence, and with me every week is the delightful Rob Dix. Hey Rob, how are you?
Very well, thank you. Episode 47. Wow, you would have thought we'd be a bit smoother by now, but never mind. We are talking this week about should you invest for yield or capital growth? And I'm really excited about this topic because, for a start, it's a really interesting topic. And also, it's come out of a thread in the Property Hub. So we know that it's something that you're interested in. And we've also been able to nick lots of other people's ideas. So it should be a good one. And of course, we've got a really useful resource of the week, which is a calculator that I think you might find very interesting.
Indeed. But before we get going, let's say a quick thank you to the people who've taken their time out to leave us a 5-star review. We love them. Please keep them coming. But thank you to Mighty Saint. Mighty Saint says, inspiring podcast. As a newcomer to property investment, this podcast filled me with inspiration and made me realise that it is possible. Having stalled so many times over the years, this podcast has given me the kick up the bum I needed after 3 months of listening. I bought my first buy-to-let with a friend and I hope it's just the start. Keep them coming, guys, and thanks from Andy B. Wow, well done, Andy. That's brilliant. I'm so glad that this podcast has given you that kick. That's just the best feedback ever. Mikey number 7 says, great podcast. Informative and follows a tried and tested formula from podcasting across the pond. 2 experts giving insight into the subject, as well as some well-chosen recommendations for books, apps, and the like. Well, thank you, Mikey number 7. And Mark Ward, Supply It, says, first investment and house move. Thanks, Rob and Rob. I've had my house on the market from the start of the year. One buyer dropped out on the day of exchange. Ooh, that's awful. The next people that viewed it had a 2 up, 2 down, so they couldn't sell it. So because of the podcast, I was confident to do a deal. All good, and now I have the house I wanted and my first buy-to-let. Started to sort out the next deposit and hopefully another buy-to-let next year. Thanks again, and as you know, I've just signed up to the Property Hub too. Mark Ward. Well, thanks, Mark. That's brilliant. Great reviews. And again, well done, Andy, for doing your first one, and well done, Mark, for doing your first one too.
Yeah, I mean, we love all reviews, of course, especially from people with comedy names. But I think our very favourite reviews are the people who say that they've taken action based on what they've heard, or even not based on what they've heard, just to hear that people are actually out there doing stuff. It's just brilliant. So it's great to know that people aren't just passively listening, they're really taking action and moving forward. So yeah, thank you so much for taking the time to let us know.
So our news story of the week, Rob, I think we could say the government is going to be pretty happy with themselves and the help to buy and pushing the property market on because they are reaping the rewards. The Treasury in the second half of 2013 took a whopping 19.5 billion increase in income. And that's made up from stamp duty, corporation tax, income tax, VAT receipts, national insurance and other income. But an extra 19.5 billion from the same time the year before. Stamp duty itself is up 2 billion on last year. You can see why the government's motivated to really kick this property market on because the amount of revenue it brings in for the Treasury.
Yeah, 2 billion. That's a huge increase in a year. And we've talked before about how the government likes to use the media to spin things a little bit. And there's just been so much positive sentiment around the property market. And there's another reason why. That's a really huge increase in tax receipts. And of course, with property prices going up and the threshold not having gone up for a long time, more and more transactions are going to be caught up in that. I hope they're putting it to good use is all I can say.
I do. I hope it's not being wasted. Right. Let's not go there. We could get quite political. Okay. Topic of the week, Rob. What have we got?
Well, this week we've got a Property Hub member, Gary Bell, to thank for this because he started a really interesting conversation in the Hub around should you invest for yield or capital growth? And we thought, hang on a minute, we haven't talked about this properly yet. And so we thought it'd be a really good opportunity to do so. So thank you to Gary for starting that conversation. I mean, obviously there are 2 ways that you can make money from property. There's the rental profits you get every month. And then there's the increase in capital value. So you can sell it for more than you bought it one day. And obviously in reality, you're going to have a mix of both those things. But which one should you be aiming for? That's the question that we're going to be getting into. Now, capital growth used to be the only game in town, really. Like back in 2006, no one was really talking about income at all. But since we had the crash and we had a few years where prices outside London weren't really doing anything, people have been getting more interested in monthly cash flow. That's part of the reason why, as we talked about last week, HMOs became more popular because they're a cash flow tool. That's what we're going to get into. We're going to talk about whether you should try and buy a high yielding property or whether you should try and buy one that you think has the most potential for capital growth. The best way to approach this is probably going to be to start out by splitting out the arguments for each of those.
Yeah, so I'll take capital growth.
Okay.
So, capital growth. If you're using leverage, capital growth has the potential to have a dramatic impact on your portfolio over the long term. For example, if you invest in an area that's 1% higher growth than every other area, then you'll end up further ahead than if you, say, went for a property with an extra £100 income a month. So 1% capital growth above average or £100 extra in revenue every month. The £100 might sound quite tempting now, but over the long term, that 1% growth every year will make a dramatic impact to your wealth. Now, the Ultimate Property Strategy course, which we've put together for our Property Hub Plus members, barely even mentions rental income because it is a long-term strategy. So we look at effective ways of using capital growth on very conservative projections, I might add. Even on very conservative projections, the numbers that you can get to towards the end of that strategy are, fantastic. Growth properties tend to be less risky. That's the other point. Properties that you target for growth are in good areas. We're talking about prime city locations here. We're not talking about, rundown areas that can deliver high yields. These are areas that are going to have and attract good quality tenants. Fingers crossed. That's the theory anyway. There's plenty in favour of, targeting capital growth, and you also don't get taxed on your paper profits as you go along. So your rental income that you'll earn along the way if you go for a rental strategy or a high yield strategy is obviously taxable.
Yeah, they're all really strong arguments in favour of capital growth. But there is one killer to this whole thing, which Andy Ridley pointed out on the thread about it. And we'll link to the thread in the show notes so you can see what everyone else had to say about it. It was a really interesting debate. But what Andrew said, quite rightly, is that capital growth isn't really a goal that you can aim at. So when you're buying, you can take a guess about which property will have the most growth out of all the different ones you could buy. But the key variable in the whole thing is totally outside your control. While growth is very nice, it's not like you can sort of sit down and work out the numbers and go, okay, this is what's going to happen, in the same way that you can do if you're going for yield. So with that, you really can kind of look at the rent, look at your expenses and know with a reasonable degree of certainty, plus or minus unexpected things, what's going to happen. That's the real killer. But then the other consideration, of course, is that cash flow is really, really important. So there's no point in having a property that's going to rocket in value in 10 years' time if you have it repossessed after 3 years because you can't cover your costs. So with high yield comes cash flow, and cash flow is, of course, the lifeblood of everything. They are some pretty strong arguments in favour of yield. But the thing that kind of muddies the waters in this debate, and this is something that Andrew Cox and Richard Brown pointed out on the thread, is that you can't really make a call about which is best, yield or growth, without knowing what you're going to do with your profits along the way. If you have a property that's making you a good income every month, do you use that money to live on? Or do you reinvest it into your property business so you can save a deposit more quickly? It's really hard to say which is best without knowing whether you're doing that. And of course, with a capital growth strategy, you can remortgage to access any extra equity you get along the way and reinvest that as well. But that is less of a sure thing because you don't know exactly when that growth is going to come or if it's going to come at all. And if you're an income investor, you'd be able to, whatever the capital value of your property was doing, you'd be able to save up that income and put it in the bank and then use it for a deposit when you're ready. So actually sitting down and modelling the whole thing out and kind of just making a decision about which one you'd be further ahead, it depends on what you're going to be doing with your income, whether you're going to need to live off that or whether it's just going to be something that you're tucking away, you're living off the earnings from your day job or your business, and your property profits and your equity are just going into the bank.
Yeah, completely agree. They're great points from both of the guys. If you don't know where you're going and what you're going to do with this income or this growth, then what's the point of doing it at all? You really need to have an end goal in mind, and then you become a more efficient investor. We've looked at capital growth, we've looked at high yield, and both have their merits. So which is best? Well, Richard makes the point that new investors' cash flow is very important. And I'd actually go as far to say, actually, cash flow is king for all investors. You have to have cash flow. So if you go for a property that gives low returns, or it even fails to break even, then if you go by the rich dad, poor dad way of thinking, you actually don't own an asset. You're then just going straight into gambling mode that you hope that that area is going to have an upward increase. Now, hopefully you've checked the fundamentals. Hopefully you've done your research and your area will benefit over time. But if you're looking for short-term growth, then I'd say you're gambling. If you accept a long-term approach to capital growth, that's fine. But if you're losing money every month along the way and you're waiting for that capital uplift, then you haven't got an asset, you've got a liability. So cash flow is king, but it's really a mix of the two that works best. Now, we often do this on a property podcast. We talk about two different concepts and we quite nicely, diplomatically end up somewhere in the middle because we're just nice guys. But it's true. You really shouldn't focus all on one or all on the other, because if you go for capital growth only, yes, you might do well. And, the argument is you could target central London now, completely sacrifice your income. But if it carries on like it has the last 2 years, you're going to make a fortune, but you don't know. Equally, if you go for a rundown town somewhere, maybe there's an industry that's shut down and a lot of people are on housing benefits. You might be able to pick terraces up for 30 grand each and the local authority will pay you £400 a month. May sound fantastic, but actually, is that town going to recover and grow in value over time? Is that ever going to recover? Is it going to give you the returns that you want? Yes, from cash flow, but not from capital growth. So for me, and this is what I always talk about with my investors at RMP, is we want the sweet spot. We want areas with the good solid fundamentals, but also deliver a good yield in the short term. So we want both. We're greedy, but you can have it if you're willing to put the research in and work hard at looking for those properties. They do exist. You can get the combination of growth and yield.
Exactly. That's the thing, isn't it? Like the holy grail is high yield and high growth. If you can achieve that, then you're laughing. And they're often talked about those two as if they're mutually exclusive, but it doesn't have to be the case. Let's dig into it a little bit. So let's take HMOs out of the picture and just look at normal single-let high-yield properties. If the yield is high, what does that mean? Well, normally the yield is high because the price of the property is relatively cheap. I mean, there's only two reasons it can be high. It's either because you're getting an insane amount of rent or because the property is cheap. So when you're looking at a cheap property that delivers a good yield, there's a question. Is it underpriced and it will revert to a more normal price at some times? You'll get that growth. Or is it, like Rob said, in an area where it's very unlikely to get any growth? Obviously, you want the former, and that involves looking at the fundamentals of the area and deciding whether it's cheap and will stay cheap, or if there's another reason, like if maybe the area is unloved for some reason, or it's been oversold, everyone's been selling and driven the price down irrationally, and it's going to come back strongly. So if you can do that, then you're onto a really good thing. In my book, Beyond the Bricks, which is coming out in a couple of weeks, one of the interviews I did was with a guy called Matt Smith, who's got this down to a really fine art. He buys when the yield is high. He makes a great return while he's holding. And then when the yield gets compressed to a certain level, so he gets the capital growth, the value of the property going up pushes the yield down. And when the yield gets to a certain level, he uses that as a signal to sell because he knows that by the time the yield has reached that level, he's had the benefit of the growth. There's not likely to be much more. And he can then pull his money out to reinvest more profitably elsewhere. It's really unusual. Like, we always seem horrified when someone mentions selling a property, and it's not normally something that people do. Matt's technique isn't what most people do, but it just goes to show that you can use yield as an indicator, and high yield can predict higher than average capital growth to come. Although we set it up at the start of the episode with high yield and high growth being diametrically opposed, that doesn't have to be the case. And if you can get both, then you're in a very good position indeed.
Yeah, I think the simple formula is high yield plus good fundamentals equals property success. There you go. High yield plus property fundamentals equals property success. Matt didn't target rundown areas. He went after areas that had good fundamentals, but just for some reason were delivering high yields. There are plenty of places like that still left. I know the property market's ticking up, but they still exist. His strategy is one that's worked very, very well for him, but you could adapt that. If you didn't want to sell the properties, you could refinance your properties and then move the money into the next areas that you've identified. So to take away from this podcast, yield and capital growth are both really important. I love what Rob summarized there because a high yield in an area with good fundamentals can really be, something that you should really be looking at and putting your focus towards. I think that's a brilliant point. So thank you to Gary Bell again for starting this forum post. Thank you to everyone who's contributed. We've mentioned a few of you and there's many more as well. Go and have a look at this post. It'll be in the show notes and add your thoughts. We'd like to know what you think. Also, this podcast today came off the back of a topic in the forum. Now, when we seen this topic, we said straight away, why haven't we covered this? It's something I talk about with my investors all the time, but I've overlooked it. I've just not thought of it. It's been almost too obvious for me, but what a great topic. So thank you for Gary for starting it. But we've also started a post, which we'll link to in the show notes again, where you can suggest podcast episode ideas and we will try and cover as many of them as possible. We want to know what you want. This is your podcast. So please let us know what you'd like us to cover. We're more than happy to do that.
Yeah, we certainly are. And carrying on a theme, really, the resource of the week this week, Rob, we've also got from a forum member.
We have. Martin Gordon. Hi, Martin. Thank you for this resource of the week. This resource came out of another topic, which was titled, Do You Own Your Own Home? It was a look at whether people rent their own home or own their own home. Now, being of the British mindset, most people would go instantly, oh, well, we must own our own homes. But actually, you'd be surprised the amount of people in the property hub that do actually rent and then invest. Rob and I don't own the property we live in. I rent because I live in a larger house. And for me, it's more efficient to rent that property than to buy it. And also, I'm moving a lot at the moment. So it's not because I'm on the run, but I'm new to the area. So I'm still trying to find out where I want to live. And I don't know where I want my forever home to be. But in the short term, I could buy, but actually it's more efficient for me to rent. Martin Gordon's got his own blog called Simple Money Lifestyle, and he uses a calculator from the New York Times. We'll link to both of these in the show notes to help you decide whether it is more efficient to buy in your area or if it is more efficient to rent, because it does change from area to area. So the calculator from the New York Times is very, very good. But what Martin's done in his blog, Simple Money Lifestyle, is put an article around that tool so you can best use it and best identify what you should be doing.
Yeah, I really, really like this calculator. I mean, everything's in dollars, but obviously that doesn't make any difference. You can just think of it in terms of pounds, but it's really, really comprehensive. It models everything out in so much more detail than I've seen anywhere else. So it's really useful, and it's going to be an interesting exercise if you haven't thought about it before. Check out Martin's post as well, because that really kind of gives you some clarity on what everything means. So lots of links in the show notes this week. Go check them out. There's lots of interesting reading and playing around with numbers for you to do.
Absolutely. Okay, well, that's us for another week. Remember, leave us a voicemail. We've had a few in recently, and we'll post them on. It's really easy to do. You just go to thepropertypodcast.com and click on leave a message, and you just record into your computer, and you can ask a question, give us your feedback. As long as it's clean, we'll play it. So let us know what you think of the show. If you have any questions, file a voicemail. And also next week, we've got a really good topic. It's called How to Take Advantage of Cash Deals.
Yeah, that's going to be a really popular one, I think. Always an interesting topic. Cash deals, they can be such great opportunities if you're in a position to act. So we're going to talk about what those opportunities are and how you can be in a position to take advantage of them.
So episode 47, Rob, we're coming up to the big 5-0. We should do something special.
Well, maybe we've already got plans in the works. Maybe I shouldn't be hinting, but yeah, keep an eye out, because in a few episodes' time, something interesting might happen. We'll leave it at that.
We'll tell you a little bit more next week.
But for now, it's been another great episode. Thank you for listening. Go and check out the show notes for all those interesting resources. Go check out the Property Hub and get involved on there. And we'll see you at the same time next week.
Thanks, everyone.
Thanks for listening to the Property Podcast. Make sure you join our mailing list at thepropertypodcast.com.
And remember, we love 5-star reviews. Rob even loves them more than air miles.